Welcome to Benefits Redefined, a series of conversations focused on rewriting the employer playbook. If you're an employer today, you're being pulled in a dozen directions at once. Rising healthcare costs, increasingly complex care decisions, growing employee expectations, and constant innovation. Too often, those forces are treated separately. Costs live in one conversation, care in another, culture somewhere else entirely. This podcast exists because those things don't actually operate in silos. I'm Richard Silberstein, and I work with a group of colleagues across the country who spend our time helping employers move beyond transactional benefits and towards strategies that actually work in the real world. Each episode features practitioners who are in the work every day, not theorists, not sales pitches, but people helping employers navigate what's next in employee benefits, healthcare risk, and enterprise strategy. In today's session, we will cover another hot topic. As benefit costs keep rising, how are employers funding risk differently? And at what point does that naturally lead to enterprise risk and captives? I am super excited today for our discussion with Prabal Lakhanpal, who has done some amazing work with our clients and helped them save millions of dollars while also reducing their risk and volatility. Welcome, Prabal.
Thank you for having me, Richard.
For those who don't know you, tell them a little about what you do as the National Practice Leader of Alternative Risk and Captives at Alera Group.
Yeah, a lot of the discussion we are having with our clients is sort of leading from a thought leadership perspective to help clients and employers think about how to navigate the ever-evolving employee benefit landscape, partnering with folks like yourself and other leaders across Alera to brainstorm what is the most efficient way for us to fund benefits. As we go through this discussion, we'll talk a lot about what is happening in the universe of employee benefits, why costs are rising. I know you're doing a lot of other sessions with other leaders who are going to be talking about some of those drivers. My focus is on recognizing that the costs are rising. How do we create a framework to create an efficient funding mechanism for employee benefits? And then carrying that forward to how do we look at it from an enterprise risk perspective and tie all of those pieces together.
Well, you do a great job of that, and looking forward to the conversation today. So when employers think about employee benefits today, what's the biggest challenge you're seeing in the marketplace, as we speak?
I think front and center for employers is this idea that costs are rising at an untenable pace, right? I recently had an employer talk to me about the idea that employee benefits is now the largest line item on their P&L, right? If you think about the idea that outside of employers in the manufacturing landscape, employee benefits is probably the largest cost item on a P&L for folks. Cost of employee benefits is going up anywhere between 7 to 12% on an annual basis. It is untenable for organizations to continue to grow at that pace, to continue to meet profitability targets. And that has really centered the conversation for employers to say, how can we rethink what's happening and how do we take more control of our destiny?
So until we solve all the drivers of rising healthcare costs, and again, we're going to have several sessions on some strategies for that, employers still have to fund benefits. So what are you seeing employers rethink about how they fund that risk?
From my perspective, philosophically speaking, self-insurance over a long-term time horizon is going to be the most efficient form of insurance. For most organizations, self-insurance, 100% self-insurance is not a palatable solution. Why is that? Because that brings a lot of volatility with it. From where I sit, captives and have created an opportunity to benefit from self-insurance, long-term pricing, and creating budget certainty while moving away from some of the challenges of the fully insured market, which create a bundled ecosystem for products and solutions, which is where captives have become far more front and center for employers who are looking to navigate that rising healthcare cost, creating in my view is the best funding mechanism for managing those expenses and costs.
So captives have become a hot topic in the benefits conversations. For the listeners who aren't as familiar with captives, could you explain in plain English what a captive is and why employers are looking at them now?
Yeah, functionally, captives are an opportunity for an employer to set up an insurance company. Captives come in a variety of shapes and sizes. There can be captives that have already been established by someone else that you participate in. That's called a group captive. And then there can be captives where you go ahead and set up an insurance company for yourself. The benefit of having an insurance company is you start to benefit from, as I said earlier, controlling your own insurance cost destiny. I'll take a slight detour to add a little bit of color around why captives work in the landscape, right? From a macroeconomic standpoint, insurance companies make money in two ways: underwriting income and investment income. Underwriting income is the idea that insurance companies charge you more in premiums than they pay out in claims and expenses. Investment income is the idea that insurance companies earn investment return on the reserves and surplus they hold on their books. Captives allow you the opportunity to benefit from both underwriting income and investment income. Most insurance transactions or fully insured carrier transactions usually don't attribute the benefit of investment income back to the insureds. A captive transaction starts to allow you the opportunity to benefit from both underwriting income as well as investment income.
Okay. And then what's changed in the marketplace that made captives relevant, not just for the very large employers, but for the mid-sized ones as well? Because I think people have this perception that captives, you have to be some, public company, large, 1,000+ company. But we've seen a lot of activity where smaller employers, both on the P&C and the employee benefit side, are, more interested in participating.
Yeah, from my perspective, a couple of reasons that have driven that trend forward more aggressively recently have been: first, 15 years ago, certainly Fortune 500, Fortune 1000 was where the maximum use case for captives sat. In fact, there's an interesting statistic out there which says about 85 to 95% of all P&C premiums for Fortune 500 companies run through some level of captive insurance program. What that really tells us is, for the sophisticated large employers, they're maximizing the use case for captives because they're seeing a lot of advantage. Captives have moved down market, right, into that mid-market space, primarily due to the idea that more and more employers are looking for solutions to bend their insurance cost curves, right? Cost of insurance across benefits as well as property and casualty has risen at a very fast pace. And that's driven a lot of employers to say, this is a problem we need to solve. And captives have become more accessible. How have they become more accessible? There's new solutions in the market, such as cell captive programs. Cell captives are functionally an opportunity for employers to participate in, the analogy we frequently use is the condo of insurance. The condo exists, there's rules and regulations around what you can and cannot do within condos, but there is an easier process to going about to establish your own captive. That, along with group captive structures, which is the idea where employers can participate in risk with other like-minded employers, has created more accessibility in the marketplace. And finally, from a regulatory landscape, the insurance regulators around the country have recognized the need to make captives more accessible and continue to invest time and energy in making sure we create a regulatory landscape across various domiciles that allows mid-sized employers to benefit from the advantages that captives offer.
Yeah, it's interesting. It feels like, at least from my perspective, that there's been more activity on the P&C property and casualty side for years. And then as people are getting 20%, 30% healthcare increases, or getting a big increase the next year, they might not get a big increase. They're like, what can I do? Talk just for people that might not be as familiar with it about homogeneous, heterogeneous captives. And if you're an employer out there, what should you be thinking about as it relates to those two different types of captives?
Yeah. So those are two types of captives that sit squarely within the group captive realm, which is the idea that when you go into a captive program, especially one which exists and is already operational, should you be participating with a risk profile which is akin to yours, which is I'm a manufacturing entity and I want to only participate with manufacturing groups? Or should you be participating in a diversified portfolio where maybe you're bringing manufacturing risk to the table, but the group as a whole has an aggregation of professional services firm, trucking shops, and you're trying to bring together that group together. There's pros and cons to both, right? When I think about participating in programs where you're sharing risk with like-minded, similar businesses, the pros is everybody understands the landscape. The con is there is a concentration of risk. That becomes especially more focused as a consideration when we're helping employers think through that landscape when you're talking about property and casualty risk, right? Take property, for example. If you're participating in a program where you're all, let's call it, educational institutions, and all of you are hyper focused in a small portion of the country, right? If you've got 20 educational institutions coming together to set up a captive in Florida, you have to contemplate what the catastrophic risk profile of that group is, given some of the property related events that have been happening there.
Right, right.
The same plays out when you think about how the groups come together on the employee benefit side of the house. The employee demographic for a trucking company is very different than the employee demographic for a professional services organization. And those are some of the considerations we help employers navigate as they figure out what is the right fit for them. When employers think about whether it's structuring a captive for themselves or joining an existing program, some other aspects that we usually talk through are how much capital is required to put a program like this together, and what level of collateral will you need to be able to fund for this. And finally, you never expect folks to exit a captive, but that's certainly an important consideration everybody should be looking at, right? To say, once we go into a program, what are the facts and aspects we should be looking at the point of a potential exit?
You've mentioned that enroll lives matter as much as employee count. How should employers think about size when considered captives?
Let's talk about why enroll lives matter, right? The first aspect is, for most employers across the country, once you exceed that 100 life threshold of enrolled lives, you are automatically able to access claims information about your group. Many states have a lower threshold of 50, but as a thumb rule across the country, 100 enrolled lives is a good benchmark for us to work with. That's an important threshold because then employers have the ability to collect actual experience from previous years and be able to understand what their experience has been for their own demographic and how that impacts pricing today and what the potential future impact for pricing is going to be. When you're working with employers that may not have over 100 lives, there is a much higher weightage that is given to how the market as a whole has been performing. So over the last couple of renewal cycles, this has been a challenge that a lot of smaller employers have been navigating, which is they don't have access to their own information, so they're unable to determine whether the 20, 30, 40% rate increases that the market has been pushing down are relevant to them and their experience, or are they just sort of getting the short end of the stick because a carrier is looking to recapture profits from losses in another group. So that's where that importance of number of employees versus enrolled lives plays out as you think about potential solutions and how you structure them. The one other aspect is a lot of tools and databases have allowed us to become much smarter about underwriting groups sub 100 lives, right? I spoke about why it's important for us to have hard data about the demographics of a particular group. However, a lot of employers under 100 lives want to take that leap towards self-insurance to be able to access better solutions in the marketplace. And we've been able to work with a lot of underwriting tools to create not perfect, but close enough underwriting solutions and guidelines so that we have an understanding of how the group as a whole has been performing. It's not ideal compared to being able to get actual data, but certainly it helps employers and decision makers get a very good handle on what the reality of their group likely is.
Yeah, and many businesses are part of some association or some group. And I think about we have a group of nonprofits in DC that go from anywhere from 15 employee lives up to, a couple hundred. That the idea is they're purchasing insurance, employee benefit insurance, as a 3,000 person group versus a 25 person group, and have many years of trend at way below whatever those increases are. So what would be, or maybe just share a little bit, because I know we've recently worked on a project, right, where groups in certain states, certain industries can really look at coming together if they have like-minded people that want to say, can we partner to do things differently and really benefit from that?
Yeah. So if I look at from a macroeconomic perspective, one of the limitations of the marketplace is the ability to look at smaller groups and price them based on their experience. What a captive platform allows you to do is aggregate lives and create an underwriting methodology that allows you to benefit from aggregated pricing. I want to be very careful and articulate that we're not talking about structuring a multiple employer welfare association. They are extremely strong solutions and can have a lot of benefits. Captives structured appropriately can allow us to create an alternate path towards allowing groups to have scale as they think about how they want to be pricing for risk. One of the benefits of captive programs is when and I know you're covering this in some of your other podcasts, so I'll touch on it lightly. When gravitating from a for a lot of small groups, when they're gravitating from a fully insured model to a self-insured model, a big value add they see is this idea of unbundling of services. In a fully insured model, you don't have the ability to pick your own pharmacy provider, pick your own TPA, pick your own stop loss carrier. When you move to a self insured model, you start to have the ability to carve out those individual pieces and pick the right solution for the right group demographic. That's a big value add when folks gravitate from a fully insured model to a self insured model. For small groups, the challenge of making that leap is that unbundling approach creates a lot of volatility. That's where stop loss solutions with captives allow us to create a structure where we're minimizing the volatility while allowing them to benefit from the unbundling of pharmacy, TPA, and stop loss, creating the platform for them to continue to evolve as the group evolves from a risk management perspective as well as from an understanding of their own employee demographic.
And for those listening in, to keep it simple, you're basically creating your own insurance company. Like, we have a bunch of captives that they retain the profits so that when they have bad claims year, they give everybody a 3 to 5% increase. When they have a good claims year, they put the money in the bank, and they just think about how they operate more efficiently. Let's pivot. If you're over 500 employees, or even if you get over 1,000 employees, what changes for those that are listening in?
When folks get to over 500 employees, it is reasonable to expect that your risk profile from an enterprise perspective is also evolving. There's some generalizations with that assumption, right? You could always have an employer that grows from 100 to 500, but the risk profile of the organization remains the same. But in general, as organizations grow and scale, the risks that they're facing, both from a business perspective as well as from a benefits perspective, have evolved. It's important to be able to identify those evolutions so that you're structuring your risk programs to appropriately keep up. A couple of examples to think about would be when you go from a 100, 200 life group to a 500 life group, your total premiums associated with the program have, especially on the employee benefit side, have grown. Growth of that risk allows you to change the way you're funding for that risk. A lot of folks will start to think about higher retentions, lower premiums to commercial markets, because you now have a lot more premium dollars to be able to balance that volatility. It's a risk reward statement, and there's a lot of opportunity that comes with the growth that organizations see. The other aspect that I'll quickly touch upon is the idea that it is likely that your property and casualty spend has also grown, be it for your liability risk, be it for your workers' comp, be it for auto, be it for property. Those lines now start to allow you to create a single program to create a diversified risk unit. We're now talking about the ability for an organization to set up a captive where they fund both medical stop loss as well as workers' comp, general liability, auto, property, all of those risks within a single condo. Why are folks gravitating towards this approach in the marketplace? For a couple of reasons. First, it creates more and more budget certainty because you're bringing together non-correlated lines of business. Think about medical stop loss and think about general liability, for example. Medical stop loss is a short tail line of coverage, which is to say you'll have a claim this year and you'll likely pay for the claim within the first 12 to 18 months. You think about general liability or workers' comp, you have a claim today, you're going to pay for that claim over a 10-year period. That amalgamation of risk is creating a better risk profile compared to looking at those two risks on an individual basis. I'll take that example one step further. Think about long-term disability and think about workers' comp. Both of them are functionally underwriting the same risk unit, which is an employee. However, an employee can never be out for both long-term disability and workers' comp simultaneously. There's no commercial solutions in the marketplace that allow you to underwrite for that risk together. Which is what a captive is allowing you to do, bring together those risks and lower the total risk profile from an organizational perspective.
Yeah. And what started the conversation, and you didn't say the word, but we've talked about that word, enterprise risk, right? And you sort of said if somebody has over 500 employees, over $2 million of property and casualty premium, that's really, they should begin the conversation. And that's where you and your team do a lot of feasibility studies, risk analysis. You've heard my expression, crawl, walk, run, right? And so just talk about that term enterprise. I mean, you sort of touched on it, the term enterprise risk in sort of plain English.
Yeah, so enterprise risk is the opportunity for organizations to not think about risk the way insurance companies want us to think about it, but think about it from where we as an organization sit, which is to say, irrespective of which part of this universe claims originate from, we as an organization have to pay for them. If we agree with that philosophy, let's create an insurance program that works for us through that philosophy rather than being limited by the shackles that are being created by saying you have to buy for medical stop loss individually and then for workers' comp and then for liability. Let's create a consolidated program that allows us to create better pricing. One of the reasons captives continue to grow so quickly in the 500 to 2,000 life space is folks are recognizing the power of long-term pricing, right? Insurance companies have a valuable role to play within the risk management landscape. Captives have the ability to offer us the opportunity to think about risk not through a 1-year time horizon, but through a 2 to 3 year time horizon. What does that mean for us? I spoke about the idea of diversified risk portfolios. Now, if we think about not being beholden to 1-year rate guarantees or rate caps, and instead think about risk through a 3-year time horizon, the increasing cost trend starts to bend itself. Because we realize that there'll be good years and bad years, but over a 3-year time horizon, we will average out. Functionally, at the heart of it, that's what a captive through an enterprise risk approach is helping an organization achieve.
Yeah. It's interesting. I was at a retirement dinner last night for a long-term client, 15 years. I think she's been there, probably worked 20 years. And there was a new HR person that came in, and she was saying that the new person was amazed at how much they've saved over the last 10 years, but how the employer is very employee friendly and put that back into better benefits for the employees. And so now you have this company that has sort of a benefit program that feels like it was the benefits 10 years ago versus increased cost, increased deductibles, right? And increased employee costs. So if I'm an employer listening and thinking, this sounds relevant but complex, what are the right next steps they should take, or what should they be thinking about?
Yeah. I touched upon a few of the considerations we help employers walk through when employers start talking about captives. First and foremost, educate yourself. Captives are a complex subject matter. There's a lot of solutions and offerings out in the market. Identifying the right one for you is an important consideration. We're doing this on a day-to-day basis with our employers, be it navigating the landscape of, is a group captive the right fit for you? Is a cell captive the right fit for you? Is a single parent captive the right fit for you? Taking all the insurance jargon and simplifying it into how should you be thinking about the roadmap of the risk that you have to fund for? You talked about crawl, walk, run. It's an approach we use frequently when we take our clients through a feasibility study, which is to say, this is where you are today. We believe in the short term, you could be looking at the following solutions with the following potential results, and these are the pros and cons that you have to navigate. Once we set up a captive, we then start to build out the various frameworks that they could benefit from as they move down that spectrum of solutions. You mentioned the idea of long-term savings in a program with your client. I think back to a client where we structured a captive program about 12 or 13 years ago. It's a medical stop-loss program, and it's grown over time. But the results of the program speak for itself. The average trend in the stop-loss market over the last decade has ranged between 10 to 20%. That program has driven, on average, savings or a trend of 3%, right? So if you compare that trend line over a decade, this is where the market trend was. This is where the average trend of the captive was. And that delta over a 13-year time horizon starts to be very, very material. And that's where we believe that captives structured appropriately can become a long-term enterprise risk solution for organizations and be that central risk unit that allows them a lot more visibility into their risk profile.
Yeah. One thing I was just thinking about is that a lot of larger companies have access to programs or point solution or vendors that say we only work in over 500 lives, over 1,000. And so that's when I've seen a bunch of business owners get together and say, hey, we can purchase insurance more efficiently if we're 1,000 plus than if we're 10, 100 person companies. And so, and we've seen the success of that. And we love working with your team. And so I want to thank you for being here today. And hopefully those listening in got a little bit of Captive 101 with some insight, and look forward to working with you in 2026.
You got it, Richard. Thank you for having me, and always have fun together.
Okay. Take care.